presented by EO Minnesota.
Welcome to this EO Minnesota webinar with Corporate 4, Joe Hoff and Matt Carlson. We're going to talk all about employee benefits and lots of fun things today. Mary Jo and Matt, why don't you go ahead, do an introduction for yourselves. Tell us your day-to-day roles.
Sure, yeah. So I'm Matt Carlson. I'm agent and partner here at Corporate 4 Insurance. Been sponsoring EO for the past 2 years. Been in the business since 2014, and I primarily focus on property casualty side. So your general business insurance, write a number of members of EO, property, general liability, work comp. I get into life and health a little bit, but Mary Jo is our employee benefits extraordinaire. So I'll let her introduce herself.
Hey, thank you.
Yeah.
Hi, I'm Mary Jo Hoff. I've been at Corporate 4 for going on 18 years now, and I specialize in the employee benefits department over here at Corporate 4. I take care of most of our clients' group benefits. We do individual, we do Medicare, we do Medicare Advantages. Pretty much if it's health insurance related, employee benefit related, it comes over to me. I've got a background in doing this for at least 18 years. I've also worked on the backside under the admin side as a person at the company that has to go out and purchase the insurance for your employees. I have a background in payroll, business ownership, so I kind of understand the whole ball of wax that's involved in the employee benefits and what the employer and the employee is looking for and dealing with. So hopefully I'll have some good information that will be helpful to you all today.
That's great. Thank you. And we have a great audience for this. Everybody here, or most people here, are employers, and there's lots of relevant information that we can share. So I'll move on to our agenda today. So we're going to we'll start off with the Affordable Care Act and what that means to employers, large employers, small employers. I would guess the majority of the people in the call today are going to be medium-sized to small employers. We'll go over the penalties that could be part of that. And then we'll talk about health plan types, fully insured, level funded, which I don't know what is. I'm interested to find out. Self-insured, individual, and non-health plans. And then we'll just cover general requirements, and we're going to open it up for questions. We are going to target about 20 to 30 minutes of talking, and we'll roll in some Q&A there. All right. Who wants to start off with the Affordable Care Act?
All right, I will take it from here. So the Affordable Care Act, most of the provisions went into effect on January 1st, 2014. Applicable large employers must offer coverage. An applicable large employer is an employer that has 50 or more full-time or full-time equivalent employees. A full-time employee is defined as an employee working 30 or more hours per week. Your part-time employees' hours, they have to be counted in the determination to determine if you're a large employer or not. So if I have a part-time employee that was working 15 hours a week and I have another one working 15 hours a week, that employee counted as one full-time equivalent employee. So you end up taking all your full-time employees at 30 plus hours a week, and then your part-time employees, you calculate how many hours they average out to determine how many total employees you have. So if you have more than 50 full-time equivalent employees, you're considered a large employer, and you're supposed to offer a health plan. Ownership in multiple companies can impact your applicable large employer status. So if I'm a small employer, but I have multiple companies and with part-time employees in there and full-time, I need to count all those employees in all my companies to determine if I'm an applicable large employer. If I am, then each of my companies need to also offer coverage to the employees that are working 30 or more hours per week. There are some requirements other than working 30 hours or more per week. The employer needs to pay 50% of the employee's monthly premium. And then most insurance carriers will require 50% employee participation if you're a large employer. If you're a small employer offering coverage, you normally need 75% participation. So that's kind of who's required to offer the coverage on the Affordable Care Act.
Yeah, that's that's an interesting viewpoint, and I think a lot of small employers don't realize that there's a lot of people in EO, especially, that might own 4 or 5 companies, and each of those companies could have 10 employees, and maybe they don't understand that they could be designated a larger company. I'm sorry, but go ahead, keep going.
Okay. right? So if you're a large employer and you're have to offer the coverage that you offer must meet the minimum essential coverages. If you don't offer coverage, there's penalties that you can pay. And if you do offer coverage, if the coverage isn't affordable or considered minimum essential coverage, there are also penalties that you could pay. So for the employer who does not offer coverage, the penalty is $2,900 per employee. It's calculated by the IRS. The way it's triggered is if you have an employee that goes out to the marketplace and gets a subsidy to help pay for their individual coverage, they'll do some checking to see if they're working for an employer. If that employer is considered a large employer and is not offering coverage, then you're going to get a letter from the IRS and they're going to say, hey, you guys are subject to the penalty. They do count your total number of full-time employees. They will let you remove 30 of them from the calculation, and then they'll take the remaining and calculate the $2,900 fee per employee, and that's what your penalty is going to be. So if I have 100 employees and I'm not offering coverage, I'm going to be able to exclude 30 of them, and then I'm going to pay a fine on the next 70 employees. Part B.
Sorry, go ahead.
Okay, there's another portion of the penalty. It's a Part B penalty, and that's for not offering coverage that's considered affordable or meets the minimum essential coverage requirement. This Part B premium or penalty is only charged for the number of employees that are receiving a subsidy through the marketplace. Again, this is triggered by if an employee goes out to the marketplace, applies for coverage, is eligible and receives a tax credit subsidy for their coverage, that is what's going to trigger the Part B penalty. Again, if they're good, the questions, I believe, when they go through the marketplace, ask if you're working, they'll ask if you're being offered coverage. They check this out. If you are considered a large employer and the coverage that you're not offering is not considered affordable for that employee, you are going to get a penalty just for that person, which happens to be $4,350 for this year. Okay.
I was going to say that some of these rules are specific federal, and some states, if you're outside of Minnesota, have different rules that may align with this, even as a small employer, like maybe California and Hawaii would be states that have rules that would align with the Affordable Care Act. Would that be covered in what you're going to talk about in the small business portion?
So pretty much for the small business, at least the states that we deal in, there is no requirement to offer coverage. If you don't have 50 or more full-time equivalent employees, you're not subject to this law. So even here in Minnesota, our small employers do not have to offer coverage, but if they are, there are some certain requirements that they have to abide by. There is no penalties for not offering coverage if you're a small employer. We work basically Minnesota, Iowa, Wisconsin are where most of our clients are that we deal with. They may have employees in other states, which isn't a problem, but whether there's other laws out in California that require employers to have coverage in place, I have no idea for sure on that. You'd want to check with the state that you're home based in to see.
Got it. Okay. Yeah. Sorry to interrupt. Keep on going.
I was going to ask you, have you actually talked to anyone who's been fined, or do you know anyone personally?
Yeah.
So like, what's like the fine level that you've seen?
These were larger employers, 100 plus. One was a fast food restaurant. It was several $100,000 they were looking at. This was a couple years after the Affordable Care Act came out. They were a little bit more flexible at that time, I think, working with some of the employers and, trying to get the costs down, working with them to, get coverage in place and stuff. So, yes, I have heard that there's.
So it's not just something that they say they're going to do; it's actually been done.
Yeah, okay. They do it.
All right.
Okay. So, as far as again on the ACA, the small employers, if you have less than 50 employees, are not required to offer coverage. Small employers who do offer coverage, you get to set some of the eligibility requirements. On a large employer plan, your coverage requirement is 30 hours. A small employer, if I've got the less than 50 and I want to offer coverage, I can say, hey, I'm going to give it to all my employees that work 40 hours a week or 35 hours a week. Most employers and most carriers in the small group market, they don't recommend offering to employees less than 20 hours a week. And partly it has to do with the employer contribution. There's sometimes not enough money there for the employee to pay for the premium, and then can throw off the participation requirements. Small employers, they're required to pay 50% of the employee's monthly premium. You can offer coverage to the spouse and dependents also, but you're not required to make any contribution towards that. Same with large employers, you can offer the coverage to your dependents and spouses, but they're not required to make a contribution toward those costs. The participation requirement for small employers here in Minnesota, we need 75% of the eligible employees to enroll in the plan. We can start a plan with a minimum of 2 employees. And when we're figuring eligibility requirements, if we have 5 employees and say 3 of them have coverage under another group plan or through Medicare, then I only have 2 employees left, and I would need both of those to enroll to get the plan in place. So the different types of plans that we have available, there are fully insured group health plans. That's where you're going to pay a flat premium every single month to the health insurance company. It's a tax-free benefit to the employee. It's a write-off for the business. You just pay your premium. Health insurance company takes care of everything else. You won't see any information on what they paid out on claims or any of their other expenses. A level funded group health plan. These have been out probably 5 years, maybe a little bit longer. It's similar to a fully insured plan and a self-insured plan. It's kind of a cross between the two. You pay your full monthly premium to the insurance company, take a certain portion of the premium, and they set it aside for the claims funding. They figure out where they think you're going to be with claims. They put that money aside, and as claims come in, they pay out the claims. They process everything the same as a fully insured plan. But at the end of the year, if there's money left in your claims funding bucket or file, however you want to call it, the employer is eligible for up to a 50% refund of that claim funding money that's left over. It still works the same as it's a tax-free benefit to the employees. It's a business expense to the company. It's just a possibility. If you have a good claim year, you may get some money back at the end of the year. The employer may. There are some catches to it. Most employers will only refund you that money if you renew with them. And pretty much they're all saying you have to renew on a level funded plan anymore, not go back to their fully insured one. So there's a couple little tricky little things in there to make sure you can get your refund. The other plan that's out there is a self-insured group plan. We mostly see large employers purchase this type of plan. You pay a set monthly premium for your reinsurance, your administrative costs, the claims funding, and then as claims come in or incurred, the employer will pay those claims as they come in. You can have a lot of variations in how much you're going to pay every month because you're always going to have your flat admin type premium, but as claims come in, some months they may be very low, other months they may be very high. Self-insured plans in the past was always a group with 100 plus employees. That's the lowest they would go for a self-insured plan. You just need you need to have some claims experience and employees out there. You need to be collecting enough premium to offset some of the costs. So honestly, we don't even have any clients that work with a self-insured type plan, but your larger nationwide companies, you will find a lot of them have that. They have a lot more flexibility in some of the coverages they want to offer, the number of plans they want to offer. Sometimes they can do multiple carriers and stuff. So it's a whole different little ball game out there on a self-insured plan. And then we also have the individual health plan markets. An individual goes and buys a insurance policy out in the market through the marketplace or directly from the company. If an employer would reimburse the employee for their health insurance plan in the individual market, it would be a taxable event to the employee. Any questions on any of that type of stuff at this moment you can think of? Or?
Yeah, it's all super interesting. I think that employers need to just look and see what fits them best. And I think that a lot of employees now, especially with millennials, it's less about the salary and more about the benefits and the things that are around that. So having aware as an employer on what you're offering your employees is always really important.
So now I'm going to go into some different types of plans that are out there. We have your traditional health plans, what I describe as, hey, they have a deductible on it and co-payments. Some services, such as your office visit and prescription drugs, those are the ones that are normally you'll see with a co-payment. Basically, I go into the doctor, it may be $30 that they collect at the time of service, and I'm done. If I go on a plan where it's subject to the deductible and no office copayment. I'm going to go to the doctor. I'm not going to pay anything at the time of service. I'm going to wait and I'll get a billing back from them after it's been filed with my insurance. And I'm going to pay whatever agreed discount amount that the provider has with my insurance carrier. And that's going to go toward my deductible. Most prescription drugs, same thing. I just pay it at the point of service at the pharmacy. I have a flat copayment. For my other services, such as lab works, hospitalization, outpatient surgery, those types of items, they're normally subject to your deductible. And once you've met your deductible, then you're going to pay coinsurance. Coinsurance is a percentage that you pay after your deductible, and you do that until you hit your out-of-pocket maximum. Once your out-of-pocket maximum is met, your services are covered at 100% as long as you're in network. Our other type of plan is a high deductible health plan, and it's compatible with the health savings account. Basically, on this plan, you have a deductible amount you pay. You pay 100% for all your services except for your non-preventive care. And then after the deductible's met, you have your coinsurance. There's several plans out there that have 100% coinsurance. So once my deductible's met, I don't pay anything. And then there's ones with 80%, 70% that then I'll pay a certain percentage of it again, so my out-of-pocket maximum kicks in. All the plans, once my out-of-pocket maximum kicks in, everything's at 100% for the rest of the year. A newer type of plan that's been out about 5 years is your individual coverage health reimbursement account. It also goes by the name of ICRA. It's a plan that allows employers to reimburse their employees for their health insurance that they purchase in the individual marketplace. They're able to do this on a pre-tax basis. They're able to do it as a tax-free benefit and give the employees the options to also put money into an HSA on a pre-tax basis. The main way that it works is it's a reimbursement plan. The employee goes out, buys their insurance policy. They turn in a paid receipt each month, and the company reimburses the employee for their costs, or they reimburse for what the employer has decided they're going to pay. They say, hey, I'm only paying 50% for this plan, or I'm paying a different type of percentage. Again, some of the employers will set this up so the employee can actually get the reimbursement via payroll deduction for their side of it, and get some. There's some vehicles out there that makes it a little bit easier for the plan to work, very similar to what a group plan does. So it's a newer option out there. With increasing costs in the group market, the individual market at times looks a little bit better. And so this is a way that an employer can reimburse the employees on a tax-free basis. It also allows the employer to hire new employees throughout the year and let them be able to enroll in the plan instead of waiting for the annual open enrollment in the individual market. A minimum essential coverage plan, a MEC plan, all that is, it's a plan that requires, meets the ACA requirements for coverage. Basically, the minimum essential coverage is preventive care coverage. It's like a 2.5-page list that the feds have put out saying, here, this is what's required to be covered on here. This plan is available to provide some protection from employers that aren't offering a full-blown plan. If I have this plan in, I am offering coverage and it's meeting the minimum requirements, so I can avoid any Part A penalties for not having coverage in place. Other type of coverages out there are your Medicare supplements and your Medicare Advantage plans. These are available to employees and beneficiaries that are age 65 or older. The member has to be enrolled in Medicare Part A and Part B to enroll in a supplement or Advantage plan. Some employers are able to offer a supplement plan as a group benefit, and not every employee that turns 65 has to enroll in Medicare. If they're still working for their employer and meeting the eligibility requirements, they may be able to stay on the group health plan. It may be a better benefit for them. So there's things that the 65-year-old plus will look at before determining which route they want to go. Plans that are still out there, optional ones, we have a health reimbursement account. These work with group health plans and allows the employers to reimburse employees for their out-of-pocket costs for deductibles, co-insurance, and co-payments. It's a tax-free benefit. The employer can set up how much they want to contribute. They can determine if I'm going to contribute 100% off the bat to reimburse for deductibles. There's some flexibility as to what the employer can do with the funds. The funds belong to the employer, and then the employer can decide if they want to allow rollover to the next year. It's basically, though, if an employee doesn't use the funds, they don't get the funds. A health savings account, these work with the high deductible health plans. If you're enrolled in the high deductible health plan, you can make contributions into a health savings account. You can do this via payroll deduction on a pre-tax basis. Employers can also contribute into an employee's HSA. The funds are owned by the employee from day one. They can be used to pay for their out-of-pocket costs for medical, dental, vision, orthodontia. These funds roll over year after year. If the employee leaves your company and you make contribution into it, those funds are the employee's funds.
I just like to point out, so I love my HSA because I basically just use it as a investment account. Over the years, I've accumulated a decent amount here, and I don't know, I just pay for basic stuff out of pocket and just continue the HSA as an investment account.
And there are lots of people that will do that, especially those that are maybe getting closer to Medicare age, because they have some options to use those funds to pay for the Medicare Part B premium. You're always going to probably have out-of-pocket costs, pretty much whatever plan you go with, and you can always pull those funds out if you're no longer working at an employer plan or contributing into a high deductible health plan. Then we have flexible spending accounts. Those have been around for quite a long time. You can set it up for medical and dependent care. It allows employees to contribute on a pre-tax basis, set dollar amounts into a medical account to pay for medical, dental, vision, and orthodontic services. Dependent daycare is also eligible to be reimbursed under there.
Hey, can we mute Michael? Or just hear some background noise coming through.
On the FSA, these funds are use it or lose it. The employee elects at the beginning of the year how much they're going to contribute into their account. If they don't use all the funds, they can be subject to losing it. The funds are available on the medical from day one. The employer has some risk out there on it. Feds do allow you to roll over $660 every year now. The dependent care, the maximum that you can put in is $5,000, and those funds have to be there before you can get it out. On the dependent care, you have to turn in qualified receipts showing that you have qualified dependent care expenses to be reimbursed. And then we have our premium only plan. That's Section 125 cafeteria plan, other names for it, but it allows the employees to pay their share of the premiums on a pre-tax basis. There's the tax savings to the employee and the employer. Basically, the employees that put their funds into the pre-tax into the FSA, the HSA, the premium portion of it, they are not taxed on those premiums that are deducted from their check. There's no state, federal, or FICA taxes, and the employer does not pay any FICA taxes on that contribution or the amount that the employee is withholding. And then some newer plans that we have out here available in Minnesota. I'm not sure if they're in all states or not, but we have some association plans. And it's available to members who belong to the Housing First Minnesota Association, the Associated Builders and Contractors of Minnesota, and the Minnesota Electrical Association. So these employer groups are able to purchase these plans. The carrier that right now offers them is Blue Cross Blue Shield of Minnesota. They have, depending on the association, 8 to 12 plans for the employers to choose from. They are rated like a large group, so everybody in that association that's in the plan, they use that for the rating calculations. They look at claims and stuff. The ratings are based on a 4-tier. You have employee-only coverage, employee-child, employee-spouse, or family coverage. Compared to in the small group market, it's based on the age of the individual. Like I know for the last few years, the Housing First, because we've got several clients in it, their rates have been very, very stable. They're looking at like a 4% rate increase this year, where I've been giving out 13 to 21% rate increases in the small group market. So they've been seem to be performing pretty well, but they just an extra benefit that you have for being in that association. Other types of coverages out there, we have dental insurance, life, accidental death, and dismemberment insurance, disability, short and long term, that will protect your income. There's accident insurance, there's critical illness, there's supplemental life insurance that are available. These are all things that the employer can add on to offer to their employees to round out their benefits. Several of these plans can be set up with no employer contribution. It can be totally voluntary basis. If the employee wants it, they pay 100% of it. What they get is the benefit of having it come out of my check on a pre-tax basis. And then future that the carriers are going to be offering as a benefit or coverage that you can buy is for the Minnesota paid leave coverage that goes into effect on January 2026. There's several carriers that I know that are working on products that will be available to the employer as an option instead of using the plan that's going to be available by the state. I think I kind of hit all the plans out there. So I just wanted to hit a little bit on a level funded visit versus a fully insured plan. There are some pros and cons to them. A lot of it's going to be on the group deciding, what works best for them. I find that larger groups with younger guys on it that never used insurance, a lot of times it works well for them because they have low claims. So there's a benefit where you can get the refund back. But some of the pros of the level funded, you have some premium savings. Most will say you can save roughly 15% off the bat just because there's some taxes and stuff that the health insurance carriers are not having to pay in. I'm trying to think about other taxes. So roughly there's a little bit up the front. If you see them coming out, I know one carrier is marketing 25% savings. It's marketing, it's 25%. You're not going to see a 25% savings. Be wary of that. But you do have your set monthly premium. You will see reports every month that give you access to your group's claims history so you can see how you're performing. It won't show individuals' names, it won't show conditions, but it will show, prescription drug usage, if there's in-hospitalization, office visits. It categorizes it for you so you can see a little bit that where the money's going. Again, you're exempt from some of the state premium taxes. You have the potential to receive a claims surplus refund, and you have your 4-tier rating. So as an employer, when I have a new hire coming on, they want to know how much their premium is going to cost. On a 4-tier rating, it's much easier to say, here it is, compared to a smaller group where it's based on your age, because then you have to get into, do we have spouse, children in there, and with their ages and stuff to calculate premium. Some of the drawbacks on the level funded plan, you may have some limited plan design. The carriers may only offer certain types of plan choices out there. There is some employer reporting that you have to do. There's some ACA reporting, the 1094 and the 1095, which a lot of times the group plan does for you. You have to do that. There's a thing called PCORI fee. It's a patient recovery fee that's been out there for quite a while. That is something that you would have to pay. The employer would have to pay. It's like $3.30 a member that's enrolled through the year. That's a filing that has to be done to the IRS. There may be some requirements, some for your plan surplus refunds, which most of them I'm seeing are you have to renew with the company and you have to renew on a self-fund or level funded plan. Again, you can't go back to the fully insured plan and get the refund. Your rates are going to be based on the history of your group, where on a small group fully insured plan, they don't look at that. It's based on the whole carrier's block of business. Smaller groups, they may require you to fill out a health history form so they can get a better idea for rating. And then there may be some mandated coverage differences. This year in Minnesota, I believe there's 15 new mandated coverages that are coming out. I know some of these new level funded plans that are renewing, they're not covering any of those requirements. So that could have an impact on some people. When you look at your fully insured plan, you have your set monthly premium. It's a guarantee issue product. They're not going to ever ask any medical questions. The carrier does all your reporting and filing of fees, and there's no health history questions on it. Again, your cons of the fully insured, your rates are going to be based on the carrier's block of business. So if they have a really high claim rate year or their block of business goes small, that can have an impact on what the rates are. And the rates are based on your age. And then there's no access at all to your group's claims history, and any claim surplus stays with the carrier. We'll say on the fully insured plans in Minnesota, the carriers do have to file with the state of Minnesota what their rate increase is going to be, and the state does have to approve it. So I do know this year, most carriers had a double-digit rate increase request, and they were pretty much all approved. So they have to have backup for those rate increases, showing what the claims been, why they need those rate increases before they're approved. So you have some extra protections on the fully insured plan, where not so much on the level funded. It's considered self-insured, so the state doesn't have as much say on some of those items on it. Any questions on that differences at this point? All right, so just your general requirements. If you're offering plans, you have to follow the law. There's the ACA that needs to be done based on the size of your company. You may have to do the required reporting. COBRA, This is a federal law. Any employer that has 20 or more employees has to offer COBRA to their employees. State of Minnesota, they say, hey, if you are offering a group health plan and you have 2 employees, you're subject to Minnesota COBRA. So that means that if I have an employee that's on my plan leaves, I need to offer them COBRA. I need to say, hey, you can stay on our group health plan up to 18 months. And if they are, then the employee needs to pay me, the employer. I continue to pay the health carrier. ERISA that comes into play for large employers. There's additional filings that are due, especially that have 100 or more employees on the plan. For small employer plans, the employer gets to choose the plans. I get to set the eligibility requirement, and it's going to be based on hours. I can't class out anymore and say, okay, I'm just going to offer to management. It's based on the hours anymore since the Affordable Care Act. We can't do the classifications any longer. I am required to pay, as a small employer, 50% contribution of the employee's cost. And then my open enrollment on a small group is not always the first year. It's always based on the date of my renewal. Right now, there's a lot of groups that are renew on January 1st. I would say probably most large groups renew on January 1st, but there's a lot of small groups on January 1st. So they're in their open enrollment, but it doesn't mean my employer is necessarily in an open enrollment. So that can impact decisions as to, gee, do I go into an individual plan? Do I stay on my group plan? Do I move to a spouse's plan? So there's extra things that go into play there. As far as the ICRA, that's going to run on a calendar year basis because it's going to tie out when the group or individual plans are at their open enrollment, which is January 1st of every year. The ICRA plan, the employer does set the eligibility and your contribution limits. This plan can provide your protection for your Part A and Part B penalties under the Affordable Care Act. There are additional fees for plan administration. There's a document fee that you have to have somebody that's going to administer and verify that your employees' reimbursement requests are valid. There's fees for that. The employee can pick any plan they want from any insurance carrier in the marketplace. The employer has no say on it and can't have any say as to what plan to purchase or what carrier to use. The annual open enrollment's always from November 1st to December 15th for January 1st effective date in the individual market. The plus on the ICRA plan is it will allow employees to come in the plan mid-year if I have a new hire. Other than that, I need to have a qualifying event to get into a plan. Your large employers, they're fully insured and self-insured plans. Again, I have to offer it to employees that work 30 or more hours per week. I am required to pay a minimum of 50% of the employee's monthly premium. And my plans must meet the minimum essential coverages and affordability requirements to avoid any penalties. And then our level funded plans, basically the same requirements based on the business side. If I'm a small or large group, I have to follow the same requirements on that type of plan. So as far as corporate and we do most of our business in Minnesota, but we work with Blue Cross Blue Shield of Minnesota, Health Partners, Medica, and United Healthcare. And quite honestly, in Minnesota, that's basically it, especially in the small group market. Large group might have some more access. Aetna, Cigna, sometimes are right in here. It just depends on the size of the company. But if you're a 50 or less employer, you're pretty much limited to 4. And then we have Delta Dental, the Guardian Insurance, Hartford, Lincoln Financial, Reliance, Standard Insurance, Unum. Those are all carriers that will write dental, vision, life, disability types of coverages. Pretty much for employer, you need to be home-based in Minnesota. If I'm writing through a Minnesota company, I can have employees out in other states. On the group side, there are out-of-network providers available to have expanded networks available for your employees that are out of state. So again, for group insurance, basically Minnesota, Iowa, and Western Wisconsin's where we write. Non-medical insurance, you can just write that in every state. Now, I went through this kind of fast. Anybody have any questions that we want to go over?
Thank you. That's a lot of information. Thank you so much. That was very helpful. I think, Mark, we have some questions that are coming in through the chat.
Yeah. If you have a question, you're on the call, you have a question, just put your question in the chat. We'll get them answered. I guess one question that has come from an EO member is, for small employers, what's the biggest challenge and issue as they're out maybe looking for the first time or shopping for new benefits, employee benefits? What would you say are some of the biggest challenges and issues?
The biggest probably challenge right now is going to be the cost. I mean, that's probably on a small employer. That's what they have to deal with more is how am I going to afford this? There's some flexibility, being able to offer multiple plans. I see a lot that in the past few years that more employers were offering a group type benefit just because the employment market, we need to find ways to keep our employees. Even with clients that we've had existing for quite a while, they went to enhancing some of the coverage. There were several of them. The white collar type businesses, they actually changed their contributions limits. They upped them. They started paying more for the employees. In the end, it's very easy to get a group plan set up for a small employer. Some of the biggest challenges they may have if they're in a business that has a lot of turnover is hitting participation requirements. There are certain classes of employees that just don't want coverage, and that can have an impact on the employer. Especially as you can't class out your employees anymore and say, hey, I just want to give it to management. I have to now include it to everybody that meets my hourly requirements. So that can be a headache trying to get through that and get people enrolled. And then, bottom line, how much do you have extra to spend to be able to afford this?
So it's kind of, figuring out what your budget's going to be and what the cost is, right? But it kind of balance with offering your employees what they're looking for, right? To attract the right talent. You mentioned ICRA being a cost-effective solution. It sounds like that there's some tax benefits with that. They're still out there. Employees are still out there getting their own plans. Is there a minimum reimbursement requirement that you?
So it depends how you're using it. If I'm going to use the ICRA plan because I'm a large employer and I want to make sure I'm avoiding any penalties for the Part A and Part B, then yes, I need to make sure that I am paying 50% of the employee's cost. The companies that administer it, they have access to the rates in the individual market because we're all age banded. Your lowest rate to your highest rate can only be a 3 times spread. So there are calculations that they have out there for the employers that are using it for this reason that says, okay, here's the minimum plan, the silver plan that has to be rates based on, here's what you need to pay to be in compliance with the law. So then that can vary because of your ages and your areas that you're in and the type of plan you're offering. If I'm using it for protection for the ACA penalty, yes, it's a little bit more restrictive on the, if I'm a small employer, I just want to offer something, there are some classifications I can do on the ICRA plan. Normally they do like to see the 50% requirement for premiums, but it's a lot more flexible than on the group plan.
Any trends you're seeing, Mary Jo, in insurance right now?
I expect I'll be seeing more as we're getting our January renewals out here, because it's going to be some tough decisions for some of our clients, especially in the small business market. Because we're used to rate increases for the last few years under 10%, the 5 to 8 range. My lowest is like 13%. I've had a 21% one. So I think what the trend's going to be is we might be looking at higher deductibles again, or we might start having to change our employee contribution limits on there. So it's going to come down personally, I think, to a lot of the businesses, what they can afford and how it's going to go. I will say I've had a couple right off the bat. They're like, we're renewing, we're fine, 18%. And I'm like, awesome. It's a lot, just depends on your business and where it's going to impact your bottom line.
Okay. Is there any wellness or preventative type things you're seeing, trends like wellness programs or other perks that people are offering?
So for wellness, I usually see that on the larger employers with 100+ employees on there. On our smaller employers, there's some wellness benefits already built into the group medical plan. It used to be, if I go to the gym X number of times per month, I'll get a $20 discount at the gym. The carriers kind of switched over in the last few years to get away from that, and they made it more of a open to everybody, so I don't have to join a gym. So if I'm walking and do so many steps a day, I'm eligible for a $20 gift card. That's pretty much what the standard is. If you hit steps X number of times per month, here's a $20 gift card you can use anywhere. They'll give you fitness trackers. You can actually have the tracker automatically feed into the carrier's programs and stuff, so you don't have to do any extra work. But that's kind of where most of the carriers have. I know there are wellness programs out there, but again, I think they're for bigger employers, and there's costs associated with that. Somebody's going to pay it. You know, if I'm going to give you $20 a month, it's coming either from the employer or another administrator. So there's going to be some costs associated with that also.
I have a question actually. So I think a lot of business owners get overwhelmed by all the different health insurance options. I mean, just going through all the acronyms alone is enough to confuse you. Like, so if there's a business owner like on this call or out there that's like 5 to 10 employees and wants to get a group plan, like what is the level of involvement that they have to take in, and like what do we take over if they're our customer?
So for basically to get a quote, we need a census. If you're a small group under 50, it's give me your employee's name, date of birth, and what type of coverage they want. If they're having dependents on there, it's helpful to have their date of birth so we can, rate it out. And from there, what we do is then we go out to all our carriers and we quote them. Usually they're down to 4 or 5 of the standard most popular type plans that the carriers have that are being written. And we go out and present those as options out there. So that end, not a whole lot of work for the employer. Give us a census. If you currently have a plan in place, we can work off of the census that you currently have, or maybe if your carrier supplies enough information on the renewal, we can work off of that. But if you've got a plan in place, it's nice to know who you're with and what type of coverage you're looking at. Just some general information is helpful. And then we take it from there. We'll come out and present you the options and stuff. A lot of times we'll bring along, hey, add in vision. Dental employees really like this. If it's not something the employer can afford or want to add in, it can be done on a voluntary basis. The employee can pay it 100%. Some people want it, then some don't. So you can offer a nice package without too much work.
Very good. Well, Mary Jo and Matt, we thank you for your time. This was super informative and I think helpful to those of us who are in EO and EOA owning businesses and trying to figure out and navigate benefits for our employees. So if anybody on the call, and we recorded this and we'll send this out to membership, but if anybody has any questions regarding employee benefits or just wants to have a discussion, Mary Jo and Matt are available. So reach out. Their contact information was shown on the slide there. So certainly reach out and they're more than happy to help you and educate you. It sounds like there's a lot of education that needs to happen for someone that's doing this for the first time. So I don't know, Brent, if you have any closing thoughts, but
no, I think it just shows how complicated this can be and how much we need people like Mary Jo and Matt to help us navigate that, and Corporate Forward to help us navigate those waters of this. Yeah, so thank you so much for helping us with this.
Yeah.
Well, hey, thank you for having us, and please feel free if you have questions, reach out to Matt or myself. We'll be glad to help you out.
For sure. All righty. Well, thank you guys.
Yeah. Thanks everyone. Go Vikings tonight.
Thank you.
Yeah, thanks.
Uncharted Entrepreneurship is a production of Content Basis LLC. Copyright 2023. You can find more award-winning content at contentbasis.io. And that wraps up the latest edition of Uncharted Entrepreneurship. Bold tales from entrepreneurial trailblazers. I'm your host, Brent Peterson, signing off after an incredible fireside chat with one of our intrepid trailblazing guests. Their first-hand perspective on conquering the unexplored wilds of business is just a taste of the rare wisdom you'll discover from pioneering entrepreneurs on this show. I also invite you to join me each week for insider commentary on the startup scene and digital marketing landscape on my Talk Commerce podcast. You can find Talk Commerce wherever you download podcasts or go to talk-commerce.com. I'd be grateful if you left a review and rating for Uncharted Entrepreneurship to help more bold founders find their way to game-changing insights that empower ventures to transform communities. This is your host, Brent Peterson, signing off for now. I'll see you around the virtual campfire next episode as we embark on another adventure into the great entrepreneurial unknown.